Hey, how you doing? My name is Eric Johnson, and I am an enrolled agent. I specialize in tax issues for real estate professionals. Most people do not know what an enrolled agent is, so I'll give you a brief explanation. An enrolled agent is a licensed, federally licensed tax practitioner that's allowed to practice before the IRS. We go in and do things like get penalties abated, get people into payment plans. We do tax reduction strategies for people. Basically anything that you need as far as taxes go, we can handle it. So today we're going to talk about tax issues that affect real estate professionals. But we're also going to talk about tax issues that cover all people who have businesses, mainly so they can stay out of trouble. All right? So before we get started, I would like to know what kind of investing do we currently do in this group?
So I'm a real estate investor as well. So multifamily investing.
Multifamily investing?
Mm-hmm.
All right.
Buy and hold. Sometimes people do wholesaling. I'm sure a lot of wholesalers are curious about how their assignment fee, how does that relate to taxes?
Okay.
Yep.
Or if you have like a mix going on, because at one point I was on 1099 and also getting income from real estate as well. But now I'm W-2 and still getting the real estate income as well.
All right. So got a few moving parts.
Right.
So you have rental income, you have W-2 income, and you have 1099 income.
Well, just recently, so 100% finance we went from 1099 to W-2 now.
Oh,
So,
good deal. Good deal. All right. What about you, brother?
Single family, turnkey, looking at multifamily.
All right. So is this only buy and hold, or are you also doing like fix and flips, wholesales?
Buy and hold primarily.
All right, good deal. All right. Just a general topic we'll talk about is the differences in between how rentals are taxed and how flips and wholesales are taxed. Okay. There are a lot of benefits to holding rental property. They're not subjected to the same taxes that someone who is flipping or who is doing wholesale deals would be subject to. Here's a prime example. Dealer status. This is a term that you should really be familiar with. A person is considered to be a dealer when their activity is mainly geared towards buying property for resale. All right? The government, the IRS, treats those transactions like inventory. So there's things that you can't do with those properties that you can do with the rental. For example, if you sell a rental property, if you've had it for more than a year, it's sold at the capital gains rate. That is not true if you're fixing and flipping or if you're wholesaling. All right? Rental income is not subject to self-employment tax. Income from rehabbing and wholesaling is subject to self-employment tax. Okay? Rental property, you can do a 1031 exchange, and that's probably a bit advanced, but you can't do that with wholesale or fix and flip type income. And so basically what it boils down to is rental income is passive, fix and flip income is active. All right? There's a lot of rules around this. I should probably have something on the board for you because to make it all make sense, it's a bunch of moving parts, but we're going to work through it, okay? But for now, are there any questions?
On the 1031 exchange, do you still have to have like a 2-year requirement, or can you do less on a whole property as far as taxes to avoid the capital gains?
Well, the 1031 exchange, there's going to be no tax. It's a tax deferral strategy. Basically allows you to exchange a property for another without having to recognize any taxable gain at that time. All right, but it has to be the same kind. But whenever you do a 1031 exchange, you're going to have an administrator that's going to basically conduct that transaction for you. They will tell you everything you can and can't do. So as long as you follow their instructions, you'll be good to go. I'm not an administrator, so I don't want to talk too much into that, But that's going to be a strategy that's going to make you be able to defer your taxes later on down the line.
Is that a quick process?
Well, as quick as any other process. It's not like an overnight thing. the biggest thing is going to be due diligence to make sure everyone qualifies. Then after that, the administrator will bring them through. I've never personally done them. I know people who have, so I couldn't give you the details on the exact transactions.
We got a friend, he was trying to do that with his 14 units, with Damien?
Mm-hmm.
But does he have to have a property already?
Yeah, you gotta have a property that you're gonna, you can correct me if I'm wrong, but it's like within 2 months.
Oh, okay.
Yeah, like I say, I've never done them myself, but your
Got it.
administrator should be able to get you straight on that. All right,
Cool.
all right. So you have rentals and you do fix and flips?
No, just rentals.
Just rentals?
Mm-hmm.
Okay. Well, for the ones on the camera who may have both, one of the biggest things that you want to do to make sure that your rental properties are not treated like your active income or your wholesale or rehab properties is that you want to have them in separate entities. You want to do all of your rehabbing and all of your wholesaling in one entity, and you want to have all your passive income come in through a separate entity. That way, if you're ever audited, you have a much stronger chance in proving to the IRS that, hey, this property is allowed capital gains treatment, or this property is not subject to self-employment income taxes. Another thing you want to do is when it comes to mitigating those situations, you want to really be clear to establish your intent. So if you have a piece of property that you know is going to be, that you intend to hold for the long term, there's things that you can do to prove that, like take a picture or a snapshot of your rental listing because it shows that you intend to rent it. Now, if you did decide to go ahead and sell it because that turned out to be the best exit strategy, you still may have a chance on receiving preferable tax treatment on those transactions. But that's one of the small things that can get people in trouble if they're not aware of them. All right. I'm sure you already know that one of the biggest benefits of holding rental property is that you're able to actually get a cash gain but have a paper loss in some situations. All right, and it's completely legal. It's mainly due to depreciation. I think it's the best thing ever made when it comes to real estate investing. The way the situation normally looks is you'll have someone that have a rental property, and let's say it's cash flowing at around $300 a month. All right, so you actually have positive cash flow. And then you go to file your return on your Schedule E. You're writing down all your expenses that you actually spent. But you also get to claim depreciation, which is basically the adjusted basis of your home, what you paid for plus improvements, and you want to divide that by 27.5 if you have a residential property, or by 39 if you have a commercial property. And that phantom expense is deductible. And so even though you earn $300 a month, you would actually be able to claim a loss of arbitrary number, let's say $3,000 or $4,000, which will actually decrease your taxable income. There are very few situations where that can happen legally, and rental real estate is one of those places.
That's why I say the rich never pay taxes.
Exactly. One of the popular strategies you probably read online everywhere is the one that talks about what is it called? Self-directed IRAs. If you're making money, you want to be socking money away into retirement. There are so many advantages. The beautiful thing about self-directed IRAs is that you can conduct entire transactions inside of there, and it gets to grow tax-free until you're ready to pull it out. You do want to be careful of good cash flow management, because once that money is in there, it's hard to pull it out without being penalized. But the method that most people tend to go when it comes to investing for the long term and not paying taxes on it is to put their assets and invest from inside of their self-directed IRA. I think one of the best pieces of advice that I've ever been given is you don't really want to own a lot. What you want to do is control a lot. If you can control the cash flow, you still get the benefit. But if you own a lot, that increases your liabilities, right? Or your risk. And so being able to control a lot of property through a self-directed IRA or even a solo 401k. You can even put properties inside of health savings accounts. There's so many things you can do with them. Almost every successful, wealthy person who has an actual strategy or system for getting rich uses retirement plans to some degree. So you want to do that. But here's the downside if you primarily do fix and flips. Now, if you primarily do rentals, rental income cannot be contributed to a retirement account. A lot of people don't like to pay self-employment tax on their flips or on their wholesale deals, but on income, when you pay self-employment tax, that income can be contributed to a self-employment plan. So if you do have that income, maximize those contributions, maximize them. Another beautiful thing about being a business owner or doing flip transactions or wholesale transactions is that we get to put away way more money into a retirement account than you could if you received a W-2. I believe for IRAs you can put in a maximum of $5,500 a year. If you have a 401k, I believe it's around $17,500. I have to check on those numbers. But being self-employed, we can put away as much as $50,000 a year. All right. The beautiful thing about that is, let's say you had a net profit of $100,000, and you did put, let's just say you put $30 into your 401k or your retirement plan. Your taxable income is now $70,000, but that money you contributed is still yours. So you got a big tax break on just taking your money from one bucket and putting it into another one. All right, where it grows, we can pull from it later. If you're not dealing with retirement plans and you have good cash flow, then you're taking the long road to wealth. So you want to use those to your advantage. Any questions? I know I'm doing a lot of talking.
No, I think I got that last part. So you said if let's say you made self-employed, you made $100,000, and then at the end of the year or throughout the year you contributed $30,000 or so to the IRA, then you will only be taxed on that 70.
Yeah.
And then later you would be able to pull out.
Thanks for watching the video. We appreciate your viewership. By the way, guys, make sure you subscribe to 100percentfinance.com. We have a plethora of tools that can help you succeed financially. We have a report on credit repair, 3 tips on how you can improve your FICO score. We also have a business credit ebook. We have a ton of real estate related documents, from deal analyzers to a mortgage calculator, a whole bunch of resources. You just have to subscribe. And one last thing, don't want to forget, we are offering free live webinars to answer your questions. This is only made available to our website subscribers. So you have to subscribe to 100percentfinance.com to receive the details as to the date, the time, and the call-in information for the webinars to answer your credit repair, business credit, or business funding needs, as well as your real estate related questions. Thank you guys again for watching, and subscribe.